Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss ongoing market volatility amid continuing tariff concerns. For some investors, it may feel like the market is stuck in Groundhog Day. The stock market is nearing correction territory again, and tech stocks are leading the decline. It's important to remember that market cycles naturally include both booms and busts. Despite current uncertainty, historical patterns suggest that this correction could stabilize and reverse once there's greater clarity on trade policies. First, this chart shows stock market corrections since World War II. It shows that pullbacks of 10% are not uncommon, and that recoveries tend to occur swiftly, taking just 4 months on average. Stock market corrections have averaged 14.3% and often rebound when least expected, as demonstrated during the pandemic, the tech bear market, and the banking crisis. The S&P 500 is once again approaching correction territory, and the Nasdaq has been in a correction for almost a month due to market volatility over the past few weeks. It's often said that the markets take the stairs up, but the elevator down. What this means is that market recoveries typically happen gradually, while declines can happen suddenly. Even though this is the case, markets also tend to make gains over long periods of time. This is relevant today because even though the S&P 500 is in correction territory, the market has only retreated to levels that were reached as recently as September 2024. So it's important to maintain perspective on long-term growth. Next, it's important to remember that trying to time the market is often counterproductive. This chart shows the value of an initial $1,000 invested in the S&P 500 under different scenarios over the past 25 years. It highlights that market returns are impacted by sizable trading days from time to time, but while avoiding the worst days is helpful, it is offset by missing the best days. Market timing strategies typically backfire, as investors often miss early recovery periods, and attempting to avoid worst market days rarely improves returns significantly, even with perfect foresight. Investors are better off maintaining a long-term focus rather than reacting to short-term market volatility, since history shows staying invested generally yields better outcomes than trying to time the market. Finally, tech stocks have entered a difficult period, with tariff uncertainty contributing significantly to market volatility. The so-called Magnificent Seven stocks have fallen 20% from their December peak as valuations adjust to potential earnings deceleration. While the tech sector has struggled, 8 of the 11 S&P 500 sectors remain positive over the past year, highlighting the importance of a diversified portfolio aligned with long-term financial plans. The full economic impact of tariffs will take some time to materialize as companies adjust their sourcing strategies, determine how much of the cost to absorb versus pass on to consumers, and trading partners decide how to respond. So it's important to keep all of this in perspective as these scenarios play out in the coming months. We hope you found these insights helpful. If you would like to discuss tariffs or the current market pullback in any more detail, we would love to speak with you. Please don't hesitate to reach out. We look forward to speaking with you soon.